let's talk about some things that you just need to understand to help you be more successful in your trading. There's a difference between price and value. Price is what you have to pay for something. Value is what that something is actually worth. What the stock market attempts to do is to bring the price and value of stocks into alignment. But I don't think it does it very well, and I don't even care, because we are not buying stocks to keep. We're not marrying any of these securities. We only date them. We buy stocks when the public perception of value is higher than the price. And what that looks like on a chart is a markup period. That's it. That's what we're doing. When public perception is that the stock is worth more than it's currently trading for, they bid the price up. We wait for the public to get excited about a stock, and then we buy it during the initial excitement phase, and we ride their excitement up, and we don't care anything about the value because we're not going to keep it anyway. We're just there to participate in the excitement. And when the excitement ends, or when the public gets jaded, or when the move is over and the price begins to fall, we get out because we trail our stop losses up behind the market. Stocks trade based on a perception of their future value. And if you watch the financial newspapers, or you watch CNBC, or you read any books about investing, they all talk about earnings growth, balance sheets, dividends, how good the management is. Those are all things that are indicative of a perception of future value. And in order for a stock to rise in price, there has to be a lot of public perception of future value. The general public believes stock value is determined by current earnings, future earnings growth potential, and dividends. Okay, I'm not going to argue with them. Wall Street manipulates these beliefs to create demand in the buying public to purchase these stocks. Now, I'm going to give you my controversial opinion. You can take it or leave it. My personal belief is that most of this stuff is phony. The only share of stock, in my belief, that is worth owning for the long term is a company that is rising in price and paying a dividend. If you're thinking you're buying stocks because the chairman of the board feels for the shareholders, you probably have a misperception, because the vast majority of stocks trading in the United States do not pay a dividend. And if the stock does not pay a dividend, you are not participating in ownership of that company. That's the bottom line. The vast majority of stocks are managed for the benefit of the board of directors and the CEO, and that's about it. So we buy stocks that rise in price. We sell stocks when they stop rising, and we stay in cash when it's a bear market or if we can't find a suitable trade. Why? Cash is your opportunity, stock is risk. The actual value of a stock is what the price is at the moment that someone is willing to buy it for you. All of this stuff about future value and potential earnings is all smoke and mirrors. At any one point in time, that stock is worth what you can sell it to somebody else for. And don't ever forget that, because a stock that's falling in value and moving against your position may be worthless the very next day. I can remember a very famous market commentator who said on TV, "I would be a buyer of Bear Stearns today." This guy claims to have 20 years of trading experience, big hedge fund manager, and he tells the general public to buy a company that everyone with any common sense knows is going to be bankrupt by Monday. Oh, I would buy it today. There's no such thing as future value on these stocks. They are worth what someone's willing to pay for them at the moment. What we look for is indications that the public believes prices are going to go up. And when the public gives us that information, then we buy the stock and we write it up. To be a successful stock speculator, you must confine your activities to stocks whose prices are most likely to be affected by public excitement and auction euphoria. How do you determine that? How do you know when the public is excited about a stock? Well, you get a spike in trading volume. You don't have to watch CNBC, you don't have to read the newspaper, you just have to have access to price and volume charts, which your broker's going to give you for free. Volume spikes show how public excitement is growing, and it creates more excitement as people who track volume go, "Wow, look at that stock, all of a sudden people are buying it." That's excitement. That's how auctions work. Excited auctions sell things for lots of money. So the first criteria that we're going to use, and you should write this down, is we look for stocks with a massive increase in relative volume. Stocks that are under accumulation look like they're asleep. We want to buy the stocks when they wake up. And you can tell when they wake up, because when they wake up, the volume spikes. So, you're looking at a stock and it's dead asleep. It's moving sideways. There's very low volume. On balance volume is slowly creeping up. But you don't want to put your money in that stock yet. Why? Because when you own a stock, you own risk. When you own cash, you own opportunity. And we want to keep our opportunities maximized and our risks minimized so we don't sit in stocks that are asleep. How do you know when the alarm clock has gone off? Well, the alarm clock of a sleeping stock is a trading spike that is 3 times the average trading volume for the previous year. So when you see a stock that trades, 10,000 shares a day, all of a sudden trades 100,000 shares a day, that's the alarm clock. That stock just woke up. Heavy trading volume is the first thing that we look for when we're seeking a new trading opportunity. You're going to set up a search criteria in your broker that is going to look for that spike in trading activity. Now, I will show you how I have done it with my broker, but each broker's software is a little bit different. So you're going to have to learn how your software does it. Now, interestingly enough, almost every stock trading company has a built-in screener that will tell you what the most active stocks of that day is. And the reason for that is they want you to trade. So they want to create excitement. Therefore, they want to pull you into where the excitement is, so you trade. But remember, we're not looking for the most active stock of the day. We're looking for a stock that used to be asleep, that the alarm clock went off on, that is suddenly about to move. And that has to do with relative volume to the stock itself, not to the whole market. So we want to set up a scanner inside your technical trading platform that is looking for at least a 3 times spike against the average trading volume of that stock. The volume spike list. The purpose of this volume spike list is to show you which stocks you should be concentrating your efforts on. If you don't have the technical ability to go into your stock trading platform and set this up, begin by using the most active trading stocks list. Now, that's going to give you a lot of stocks to look at, but you're going to use them by looking at the charts. And I'm going to show you how to set up your chart. So if you have 50 stocks to look at every day that are on the most active list, you're going to be able to bang through that really quickly and see if there's anything there that fits this criteria. And then I want you to call the technical experts who design the software for your particular brokerage and ask them how to set up a screener that will show you when a stock has boosted 3 times its average annual trading volume in one day. And they'll tell you how to do it because they want you to trade. Now, later on, I'm going to show you how I've done it with my broker, and if you use my broker, great, you'll be able to do it. The purpose of looking for the volume spike is to give you stocks that you can concentrate your efforts on. There's 5,000 different securities trading at every given point in the stock market. The vast majority of them are not worth looking at. There's no point in wasting your time looking at a bunch of dead stocks with no public interest that are likely going to fall in price anyway. We want to concentrate on the sleeping giants that have just woke up. We trade stocks other people want to buy.